Owning your own business can be so confusing when you first start, and you could be leaving thousands of dollars on the table. So if this doesn't sound ideal for you, you'll definitely want to stick around to the very end of this video to make sure you're maximizing your tax returns. My name's Alana Bevan from Cosmopolitan Academy. You may have seen me on the TV show Legacy Makers or in one of the many global publications globally. As a multi-certified global trainer, I've been helping artists just like you learn the absolute best techniques and pro tips to become successful in the beauty industry. If you want to see how to become a diamond tier business owner and simplify tax time, you'll definitely want to stick around until the very end of this video. Money looks better in your account than in the government's. Let's be honest about that. But don't stress if you miss any of it, because we can send you all of this information in our free 8-week PMU bootcamp with additional content to scale your beauty business in the description link below. So welcome, Vijay. Thank you so much for taking this time. I'm just going to do a quick intro as to your background.
Sure.
So Mr. Vijay Kalra completed his undergraduate degree in BCom from Shriram College of Commerce, the topmost school in the University of Delhi. In 1992, he started his independent accounting firm in Canada and continued in the public accounting sense. In almost 40 years of being in his profession, Mr. Kalra has worked in a vast variety of business situations for clients of all sizes and industries. Having worked extensively in various facets of the profession, Mr. Kalra particularly enjoys working with growing businesses like ours. He has a vast knowledge in setting up tax models for Canadian IP-intensive companies. He has set up and administered offshore tax entities and also brought into Canada many companies from the USA. So welcome, Vijay, and thank you so much again for taking the time to do this with us.
Thank you, Elena. Thank you for kind words. Yes.
What are the tax benefits of going sole proprietor or corporation? What do you recommend for a small entity when we're first starting out and probably don't have employees, probably not making a profit for the first year or two? Should we still be, is there benefits to being incorporated? Is it worth that $800 to incorporate, or is it best to stay sole proprietor in your opinion?
So there are pros and cons, but let's take an example, a typical example of where your franchisees normally start. One person, and they're probably working elsewhere, and they start this as a part-time thing. And for starters, it's a good idea to keep it under your personal name.
Okay.
Why is that? It's because if you have a certain amount of loss in the first year, then the loss from this business can be offset through income earned from other sources within your personal tax return. The difference here between having the business in your own name versus having a corporation is, if you have a corporation and there are losses, then the corporation carries those losses. And it can make use of them when it has income in the future years. But your cash flow is affected seriously at this time, because if you're losing money, then cash is going out of your pocket in expenses. Nothing is coming back. That's the corporation scene. If the same losses were incurred in your business that was owned personally, then you would report those losses to your personal tax return, and you'll be able to claim some of the taxes that you have paid from other sources or that are due from other sources.
Okay.
So let's say you had a salary of $50,000 and your employers took out $10,000. In addition to your employment, you started this business and you had a loss of, let's say, $15,000. So your taxable income in this case would be the income you received from employment, which is $50,000, less the losses you had from the business, which is $15,000. So your taxes would then be on $35,000 instead of $50,000.
Right.
So that gives you some tax advantage. The taxes that were calculated on $50,000 would be more than what would be on $35,000. That's the advantage in not having an incorporated business.
That's a big advantage at the very start of a company.
Yes. So it is a very good idea to start unincorporated, but you reach a threshold in business. A certain high threshold when you reach, you want to get incorporated. So first thing, why should one get incorporated?
Yeah.
So it's common ideas from the standpoint of running a business as an entrepreneur would be, if you have a corporation, your profile looks bigger and better always. That's the first thing. Second, more important thing is what's called limited liability issue, which is that when you grow in business, liabilities issues in all sorts of business arise. And when you have a corporation owning and running that business, and you are behind the corporation as director, as beneficial owner, then it creates a layer between outside world and you personally. And that's the corporation. So for very few things then, can you be held personally liable if there was a serious financial issue or a reason for someone to
Lawsuit, something like
to
that.
have an action against you. So that's one big advantage, limited liability. Second advantage is, once you have a certain level of income and you have a corporation, it provides, the corporation setup provides a tax planning tool between you and the corporation. Your accountant can then look at what would be the best case scenario in order to optimize your taxes. And it is done by using the differential year ends, because a corporation can have any year end.
Right.
Personally, you have only December 31st year end,
Yeah.
January 1st to December 31st. A corporation could have June 28th in theory, and it's
Right.
okay. So first thing is, between differential dates, you can plan your taxes. And second thing is, the tax rates are differential. On the corporations, for a small company in Canada, in Ontario, that is located in Ontario, you pay about 12% corporation tax on $500,000 of net income. So you could be making $1 million in sales, and after your expenses, even if your income is $500,000, you pay 12% tax. Whereas if you had the same amount of income in your personal name, for it being a business in your personal name, then on $500,000, you could end up paying as much as $250,000, 50% of it.
Yeah.
So there's a very big difference. And
As you make more.
as you make more.
Yeah.
So if I had to draw a thumb rule on this, I would say when you start making more than $6,000 to $7,000 a month in sales, it's time to seriously look at incorporation.
How much? Sorry?
6 to 7, I would say $6,000 or north of 6,000, then you should start looking at corporate setup. It's a good idea.
So let's quickly recap the basics to tax time for a sole proprietor. Number 1, know your tax write-offs. Number 2, look further into the tax benefits of becoming a corporation rather than a sole proprietor. And number 3, always seek professional advice before making tax decisions, as there can be some legalities to know. So if you love this video as much as I loved making it, then show some love and give me a subscribe, like, and of course, we want to hear from you. So give us a comment on what you want to see in another video. As our appreciation for your view, don't forget to take your free 8-week boot camp in the description link below. And if you want to jump out of taxes and into everything microblading, you'll definitely want to watch our next video on step-by-step microblading simplified for best results. I'll see you in the next video.